Good morning. Let us start by reviewing very quickly what has happened during this week, because it's not all that important compared to what is going to happen by the end of this following week. This Friday, the 24th, prices will be nowhere near the prices we see today on the screens. The two-year note has had a very good week. It has managed to rally quite substantially. It is still in a long-term downtrend, but it is very much moderating, and there is not much change or much chance that this falls very much lower in the subsequent week, whatever the result of the Brexit referendum. This can be seen quite well in the 5-year note, which is the belly of the curve and the area that we like most. We've changed these lines now that the contract change has taken place, so they're slightly deceptive. We think that it has established a trend. The trend is for lower yields, higher prices, and that whatever the result of the Brexit referendum, it's just a question of the steepness of the ascent. If there is Brexit, nothing will hold it on the upside. You can forget about finding levels. And on the other hand, if there is no Brexit, we will come back down towards the 121 area and establish a low here and then rally again eventually. 10-year notes even more bullish than the 5-year notes, but that shouldn't last because the belly of the curve should now start outperforming the rest of the curve. Again, we think that it's quite obvious that the fall on a no Brexit vote would be at worst towards this line, the 130 and a quarter line, and at best, I mean, nothing holds it on the upside. You can forget about upside levels. If we can see 130 and a half to 130 and a quarter, we will be buyers whatever the result of the Brexit referendum for long-term holds, and we will explain that why later on. The Europeans are again, we've had the contract change here, so it's a mess of a chart. But the Schatz will actually be very interesting next week because it could absolutely fall apart, and so could Bobble. Bunds less so, but Schatz and Bobble we could really have. I mean, what a mess of a chart because of the change in contracts. Nonetheless, the yields did come off last week on a flight to safety, I guess. But the eventual result could be much lower prices in Schatz and Bobble, which we will explain in a second. Bunds are the ones least affected by the change in the contract, and on a daily basis we have actually maintained this very nice uptrend. So it's basically technically telling us there is not a lot to do here. If you're long, you hold longs. If you're short, you only short it on a break of this line, basically on a closing break, preferably weekly, of this line. And until then, you don't do much of anything at all, if you don't want to buy it, that is. So that's a very quick review of the interest rates, review of the of equities. Well, equities, as we thought, have come back and they've tested the lower end of the Bollinger Bands, and they actually spiked the 23.6% retracement line at 2043, which is a healthy development. We cannot get too bearish of this contract at this stage, and we will also explain why later. At the moment, it's done nothing wrong. It has basically retraced as people have taken off their positions ahead of Brexit or hedged them. So there is very little that this contract has done wrong at this moment. The other contracts are very similar. Let's look at DAX cash. This is what we gave you last week, that this is, the buy zone, which is of course extremely large because it depends on the result of the Brexit referendum. We never even got to the top of it. We held a very tight week with a gap, and now we're setting ourselves up for a large move in either direction, which is unsurprising really. On the weeklies, you can see that even better. We've held the 200 weekly moving average. The Bollinger Bands are in neutral. So what we can say with some measure of certainty is that either the top or the bottom Bollinger Band will get spiked next week. So you're talking about 10,500 to at least 9,150. This will be probably below 9,000. So anyway, this is what the technicals are telling you. This is what we have prepared for you in terms of our expectations. If there is no Brexit, we think the risk on will definitely return. And the US should spike the 2090-2100 area where it came from, which was the breakdown point. Probably pause there because it's a crucial area, and then in a subsequent leg spike 2120, and that would be as far as we expect it to go. Whether that is 2120 or 2130, I mean, who cares? But that is the area that we expected to stop and then decide over the course of many days which further action it wishes to take. But if we are long 2120 is our ultimate target, we don't want to be involved much above 2120. DAX, similarly, it'll on first news it will immediately spike 10,200, possibly pause and then spike 10,500. The 10-year note should move into the 130.16, 131 area, and it'll be crucial what it does there. We think there will be buyers down there, whatever the result, because we think that the market has basically now decided, and the Fed has confirmed, that the rise in interest rates over the next 18 months is going to be minimal. And therefore, with European yields all at sub-zero, even in 10-year notes, and Japanese yields being vastly negative, there is only one game in town, and that is the US bonds. People will buy them on any serious setback and just lock them up, and that'll be that. So we think there will be definitely buyers around the 130.16, 131 area. The British pound should test 148 immediately on the news. Let's have a look at the British pound, the cash, that's euro, here we are. 148 is basically this descending line and the 200-day moving average. This kind of level, 148, it'll take out all these stops. It'll just go and take out all these stops. It'll spike 148 and probably stop somewhere around the 149.50 area. That's going to be its immediate reaction. A spike of this area, it'll take out all the stops, and if you want to sell it, you can easily probably sell it around the 150 area. We don't think it holds it. We think over the next couple of months this trend will reestablish itself. Nothing much has changed. The market was coming down. Before that, it'll spike it'll continue to come down, and we will probably be around the 145 area again within 3 months. Let's go back to the... Now, Euro will definitely go up to 114.50, 115, but you should leave it alone because there are just too many cross currents as far as the euro is concerned. For a start, there's Euro GBP. People will be buying GBP, selling euros. On the other hand, there will be risk-on moves, so people should be selling euro and buying dollars. But people will be selling dollars. So there are really huge cross currents going on. Let's show you the chart of the dollar index. We would not be surprised at all if the dollar index spikes the lower 93.63 area again and possibly comes down all the way to these levels around 92. It wouldn't be surprising at all because that would be consistent with risk on. And therefore, because of all these huge cross currents, we really wouldn't touch the euro past 115. It might go higher, but so what? It's not the high risk, low risk, high reward trade. Now, gold could be very interesting. And that is the one we shall be watching, not because we want to trade it so much, but because we want it to give us indications about the extent of risk on and risk off. If we have a look at now the gold chart, and this is the weekly, I mean, you can see how beautifully it's positioned. It's positioned ready to break this line. The 200 week moving average is there, the Bollinger Bands are there, basically everything is here around the 1300, 1310, 1320 area. If there is no Brexit and there is risk on, and it makes sense that people who have bought gold as an insurance policy should actually start selling it. There could be no bid in this market for the first couple of days, which basically means that it could come and spike the bottom of the Bollinger Band. So it could come all the way down to 1180 before going straight back up, because for several reasons. A, because there will be still no change in Fed policy or ECB policy. Rates aren't going up anytime soon. The dollar should be coming off. So many cross currents here, but the first technical reaction is going to be very interesting. If we cannot break 1250, then this contract is just going to do a very quick dip to 1250 and then possibly spike and break the trend line and go higher. So that is why we are saying we are going to be watching gold and not forgetting to buy it either at 1250 or at 1200, 1180. Shats and bobble, avoid. Now, what does that mean? That means that we don't want to own them at any level, because finally what could start happening is that people could start saying, why should I park my money at minus 40 basis points per year when I can get involved with the equity rally? We think that FOMO, fear of missing out, will really start kicking in equities, which would longer term become a top. But in the short term, we think that people will pile into equities out of low yielding or negatively yielding assets, and that could have a big effect on the drive higher in equities. Now, the shock beneficiary of all this, if there is no Brexit, actually could be the one that nobody's looking at, and that is the Nikkei. Let us have a look why. Here we have Euro Yen. Now, Euro Yen has basically spiked the bottom of the downtrend line around the 115 area. It has now come off since the beginning of the year by nearly by nearly 10%. Let's have a look at it on the weeklies. It has come into an important area of support. The moving averages are still pointing higher. It is through the bottom of the Bollinger Band. So if it now spiked and came back towards the 127 area, it really would not be a humongous surprise. People have been buying yen on a flight to safety. If now they start their reverse and start selling yen and buying euro, or even better, don't forget these are the lines that we drew many weeks ago, and you can have a look at them. These were our buy levels in dollar yen, 103.72. Last week it spiked it. We could have a very quick move back up towards the 110 area without much difficulty from here. Without any difficulty at all, we could be at 110 within 2 or 3 days. If that happens, and there is a risk-on move in equities, Nikkei on a weekly basis, here we are at the bottom of the Bollingers. This is the 200 weekly. The Nikkei could go and spike the top, 17,500. So that is from 15,000, where do we close? 15,600 to 17,500. That could be a substantial move in the Nikkei by the close of Friday next week. So that is really the dark horse, the one that you are going to get most bang for your buck. We shall see. Now, if there is a shock Brexit, and we'll tell you now why it would be a shock. Let me put up this. This is the Ladbrokes betting forum. These are the odds that they calculate. So there's a 73% chance that there will be no Brexit, and only 27% chance that there will be. Now, last week, this thermometer here moved and led the markets. When it came down to 58% likelihood, the pound was basically wetting in the bed. And now that it started moving back up, and it's been moving back up Thursday and Friday, and again now on Sunday morning, you will find that the market will probably be higher tomorrow morning. It's basically leading the market in both directions, both up and down. So watch this thermometer, see how it how it moves, and follow it in your trading. Now, what are we saying now? If there is a shock Brexit, 2020 will not hold the S&Ps. This is, well, damn it. Believe it or not, we lost the last 20 minutes of the presentation because there was a technical error with my computer. So I will very quickly go through the Brexit scenario again because I'm now very late. The Brexit scenario basically says that we will very quickly, you can forget about the 2040 area and you can forget about the 2020 area, it'll get spiked. We shall be going down towards the 1920 area, which is this 0.618, 1923, and it's always been a very nice swing area. That's the level that we think will catch it and the level where we will be buyers. That very nicely actually ties in with the Blue Angels, which will now reopen. I'm sorry because I've done this all already, and we had this technical difficulty that it stopped recording for a good 20 minutes. I apologize, but what can we do? And you can see how beautifully that would coincide with the 15 times implied earnings line. Every time that the market has had a scare, it has always come back towards that 15 times line. So 1900, 1920 will be our buying area, and we would be quite confident of a very good risk reward to the upside from that level. Nothing much before that. We don't think the 16 area holds it. It'll go straight down towards the 15 area unless the central banks do something amazing, which we don't really expect. The one thing that might be absolutely dead in case of Brexit is the financials. And here we are. We think the financials, which are very close to the top of their trading range in any case, could come down and spike this 11 times line, which is around 250. And that is, well, that's nearly a 20% move in financials. So the biggest bang for your buck, if you trade individual equities and stuff like that, could be in shorting Goldman Sachs and JP Morgan and stuff like that. We think they will definitely come off more than the index itself. The index itself will come off a good 6%, but these guys are going to come down a good 20%. So that is what we're telling you. The other thing that we're telling you is watch the yen. We think that the yen has probably done all it can do, and if now it gets caught here around the 101 area and it can't come down any lower than 101, you will know that things are really not as bad as they seem, and that the risk reward at that stage will be for a risk on move. The area that we do like, which is the 5-year note, we expect it to come down to this area just below 121, and that is where we want to buy it again in either case, because if there is a Brexit, you can forget about that. If there is a Brexit, it'll go much, much higher. But if there is no Brexit, we definitely want to buy it around the 120, 121 area. And as we said, I don't know if I'm repeating myself, Schatz and Bobble, if there is no Brexit, you don't want to be anywhere near them, because people should be going out of negative interest rates into positively yielding assets. And if there is a Brexit, you you certainly can't buy them, so you want to avoid them in any case. If there is no Brexit, you want to be actively selling them. Let's see if we've done gold again. The question about gold is, do you buy it 1250 or do you buy it 1190, 1180? That's the only question we have about gold, and we will be watching it very closely to make sure that we don't miss that train when it starts leaving the station. We hope that we've given you a good idea. We've given you levels that we wish to trade. It's going to be very exciting. It's going to be whippy. So maybe smaller positions with larger stops would be called for. Our preference is for the upside in equities and possibly some downside in bonds, which we'll be keen to buy. US bonds, that is, certainly not European bonds. And if trade we will definitely be buying some Nikkei overnight just to see how it feels, and we shall good luck to us all. We are sorry that we've missed the last 20 minutes of the presentation because of technical difficulty, but we hope that we've given you a good idea of what we think might happen. Thank you.